All right, what's going on, everybody? My name is Brendan Murphy, and today I'm going to be talking about why you need to expect your trading strategy to fail at some point or another. And the reason for that is because it will. Just by mere probability, at some point or another, your trading strategy will fail and it will stop producing returns. And so you need to be prepared for that. Because if you're not, your wins are going to turn into break evens, and then your break evens are going to turn into losses, and that's going to only get worse, and it's going to lead to you losing your capital. Now, what causes our strategy to fail? So when we design a strategy and we backtest it, there's two things we can do. The first one is that we can optimize it for a certain market condition. So for example, right now we're in a bearish market. We can make a strategy that takes advantage of a bearish market. Let's say it has 50% bigger position sizes short than it does long. And so it performs really well in this market. But what happens once this bear market turns into a bull market? Now we still have 50% bigger sizes short, and now our returns are going to be eroded, if not completely erased, because our strategy is not built for the current market. So that's option one. Build a strategy that is made specifically for one market, so that it produces exceptional returns in one kind of market. The other option is to develop a kind of all seasons strategy, so that it performs good in a bear market and good in a bull market and good in a ranging market. The problem with this is that your returns are going to be a lot lower when you do this. And the reason that your returns are lower when you do this is because you have conflicting goals. To make money in a bear market is an opposite goal to make money in a bull market. So if you try to optimize for a bull market, you're going to be hurting your performance in a bear market. So if you optimize for all markets, your total returns as a whole will drop. And so that's why I personally opt for option number one, where you make it specifically for a certain kind of market. But as I said, inevitably, that leads to your strategy failing at some point or another. And so what you need to do is you need to have a backup plan, or at least a plan to deal with your strategy once the failing time comes. And what I usually do in this instance is I'll take the strategy, I'll reanalyze the market, and I'll say, okay, this is the kind of market we're in right now. I need to adjust my strategy in this way so that I now become profitable in this kind of market. And I'll do that, and then I'll become profitable again. But usually there's a 2 to 4 week span where your returns drop and then they reverse, and you also need to realize your strategy is failing. And that's kind of hard to decipher, because sometimes your strategy has losing trades. All strategies have losing trades. So you need to have a certain time buffer to be able to differentiate between this is just a little short losing streak in a good strategy, or this is my strategy failing. And so that's why it's usually a period of 2 to 4 weeks at least. And so what I like to do is I like to optimize the strategy so that it performs really, really well in a market. I get really good returns. And those returns I kind of think of as a cushion that absorbs the blows from when the strategy stops working, and that gives me time to update my strategy so that it is profitable again. So for example, we're in a bear market. I make a super good bear market strategy, and that makes me, let's say, $5,000. Then the strategy stops working, and then I take a $1,000 loss and a $2,000 loss. So now I have only $3,000 profit left. And by now, that $3,000 loss, or that $2,000 combined loss, that's given me enough time to realize the strategy is failing and adjust the strategy so that it is now profitable again. And so now that 3,000 profit I had left grows by another 5,000, let's say. Now I have 8,000. Then I take another 2,000 loss while I update the strategy again for the new market condition. Okay, and so then that drops me back down to 6,000, and then we grow it up to 11. And so the process for me, it looks like make an exceptional strategy, profit off of the market, have enough profit that I've got a nice cushion that I can sit on while I adjust my strategy. Profit again, lose a bit in the cushion, adjust, profit again, lose a bit in the cushion, adjust, profit again. This is the protocol that I follow for maintaining profitability in a market. And for me, I find this usually comes in approximately 6 to 12 week waves. There'll usually be a period of 6 to 12 weeks of nice, awesome profitability, followed by, as I said, the 2 to 4 weeks of reduced profitability or losses, most likely. And so the lesson in this video is to make sure you have something in place so that you can realize when your strategy is failing and know how to adjust it so that you can maintain profitability when market conditions change. So if you found this video valuable, please hit the like button, leave a comment below, and subscribe to the channel. Make sure you click the little bell to never miss out on the latest ways that you can improve your trading. And if you want to take it a step further and work with me, go to mie.trade to view my professional services. Thanks very much for watching the video, and I'll see you again in the next one. Bye-bye.